Welcome back to FinWeek Money Matters. Now, financially savvy South Africans are aggressively considering offshore options to diversify their investment portfolios. With a relatively small exchange-traded fund ETF market in South Africa, investors have not had many options to consider around this, but the investment landscape is changing rapidly, and there are both local and international options now available. To discuss this further, we have Mike Tonkin, Head of Institutional Sales at SAXO Capital Markets, and Nerina, Visser, Head of Beta Solutions at Nedbank Capital. Thank you so much for making the time to join us. Maybe let me start with you, Nerina, just to paint the domestic landscape for us. Why are we seeing such an increased appetite for ETFs as a vehicle to get offshore exposure?
It's quite simple. You look at the performance of the rand. Unfortunately, when you look at what the currency has done, and in particular to the US dollar, for many, not just private investors, but investors across the board are looking for ways to actually capitalize on the performance of the currency. And in many ways, they look at international investments as a way to do so. So unfortunately, people sometimes sort of see it as just one investment decision and don't realize that you really should be thinking in terms of two separate investment decisions. The one is, where am I going to invest offshore? And then the second one would be, what is the currency implication of what I'm doing? Most of the international investments are mostly sort of affected by the dollar. So looking at the rand dollar is really the appropriate one to look at, but there are other nuances also at play.
Do you think it's a bit of a, one of my issues with, we've seen obviously Deutsche Bank have the X trackers, so you've got your Japan, your US, your world and UK exposure, and then there have been a couple of Africa things that have been added. But it feels very much, it doesn't feel like a particularly dynamic offering, and fair enough, it's a baby industry here in South Africa, but it doesn't feel like we have enough options in terms of local offering. Are we going to get to a point where South Africans can be more tactical, or is it going to be a very general offering that we're going to see in South Africa?
I think ultimately, yes, we will see more of an offering, but I don't think it's going to come just yet. I think the industry do need to mature, and I think we need to actually move beyond the way that we're using ETFs at the moment. So people do really need to start actually thinking in terms of their investment decisions beyond the currency play. And I definitely want to caution people about deciding on taking money offshore now because of what the currency has just recently done. That is the worst decision you can possibly make. So to look, for example, at the DBX Tracker's Japanese ETF, for example, over the last year it's given you 56%. If that is the reason why you're investing there, worst decision ever. If your reason to invest offshore is because you're looking for diversification into other industries, into other geographies, things that we don't have exposure to in South Africa, absolutely the right decision. So be sure why you're doing it, and then stick to that decision. Don't then tomorrow, when the rand suddenly strengthens, or there's another reason that sort of counteracts that gut feel that you had, suddenly change out of that decision. It should be a longer term decision.
So how are the majority of South Africans using these tools right now, do you think?
I think for many of the private investors, one of the big attractions also is the fact that this comes outside of your normal forex allowance. So you don't actually have to take it out of your normal allocation. It trades on the JSE in rand terms, both buying and selling. Most of them pay dividends as well. Certainly the ETFs do. The ETNs don't pay dividends. They are all total return investments. So they do generate total return, but it's reinvested for you. So I think for most investors, it means that they can trade these alongside all of their other JSE listings, which really is attractive. And I do think that the costs associated with it is not onerous. Yes, it's more expensive than your domestic ETFs, but considering that these are international ETFs, that your currency exchange is taken into consideration, that your global custodianship is already done for you, I don't think that it is an expensive offering at all.
Yeah, I mean, I guess one of the questions I'd throw to you then is, one thing I'd love to be able to do is be able to buy access to the technology company overseas, your Googles, your Apples, etc. It's probably too expensive on an individual basis to buy for an ordinary retail investor. What are the options in terms of ETFs to be able to buy using, say, the SAXO platform to get access to the more tactical exposure?
I think the interesting thing is, you sort of point out a few companies and a few industries, but South African investors that are starting to take funds out of the country are used to a very small market. So now suddenly you've got an international trading account, and you get given the options of 30 plus exchanges to go and try and select shares, and the majority of the shares are completely unknown. But the investor will know that he wants access to North America, Europe, Asia, etc. And although the underlying companies may not mean anything, ETFs are fantastic because they'll allow you to get access to a region or an industry or a sector or even an asset class. You know, we're not just talking about equity ETFs, you know, there's fixed income ETFs as well. So you can build a multi-asset class portfolio using ETFs. And as you touched on, investors that are taking off a relatively small amount of money aren't restricted. You know, they can buy one, that's the fantastic part about it being exchange traded, you can buy one share. So even smaller investors are able to, with a very small amount of money, get a very broad, diversified portfolio.
Are there any suggestions around dividend investing? Obviously, Satrix Divi is a well-known local story, but what about in the international markets? What's popular there in terms of sort of dividend yielding type instruments from an exchange trader?
I mean, as you can imagine, there's probably, on the US exchange, the ARCA exchange, there's over 8,000 instruments. So, you know, as you were saying, is this market going to grow? I think even if it grew 10 times, you know, in a year, it's still going to be miles and miles off what we're seeing on the international space. And in fact, if you look through any of the platforms that offer these ETFs, you'll really be surprised at the amount of variety out there. You know, even equity ETFs, you get long, short ETFs, you get geared ETFs. So, you know, in the fixed income space, and in fact, all the outflows that we've seen over the last couple of months out of the ETF space has actually predominantly been out of the fixed income ETFs. You know, with bond yields rising in the US, we're really seeing a bit of a reversal in that space.
With all that variety that you speak of, Mike, are there very specific red flags that one would have to look at before they venture into the space that can be generalized across the spectrum?
Well, I think my first bit of advice would be to stick to the big providers. I mean, you know, most of the big providers, your BlackRock, your iShares, your HSBC, your Deutsche Banks, your Lixor, you know, I would tend to stick with the big providers. You've got to stick with one of the big funds. You do get a lot of smaller funds out there, more specified industry sectors, etc. You tend to have a little bit of a problem with liquidity, so I think that's a bit of a risk. So you need to look at the spreads on those ETFs. So I would tend to stick to the big, high traded volume, daily traded volume ETFs out there from a good, solid, well-known provider.
Does the same hold, sorry Jessica, does the same hold for the domestic market though, where you actually have the space and maybe even the scope to go industry specific and get into that a little bit more detail? Would you still have to stick to the big funds domestically?
I think what's quite important is to differentiate between where the domestic funds are different from and if I say domestic, I'm specifically referring to the locally listed funds, especially those ones that are actually unit trusts or CISs as well. So the majority of the ETFs on the JSE are CISs as well, unit trusts. It's a very important differentiation because these are all physically backed. So it means 100% of those assets are actually held in trust by the trustees of these ETFs. It's an important difference from any international ETF. So when it comes to liquidity also, the South African ETFs are offered via market maker, which gives the investor a guaranteed counterparty. So it doesn't matter whether you want to buy or sell, you know that there is a counterparty that will do the opposite side of the trade for you at the NAV. So I think from a domestic trading point of view, the risks are definitely less than it might be in an international one. So for me, trading these internationally, that provides wonderful opportunities, but you need to do your homework, just like you would with any other investment. Right. But it's a different type of homework that one needs to do when you're investing in ETFs than it would be if you're investing in a single company or if you're investing in a fund, for example. Very important to look at what is inside the ETF, what is actually being tracked, how is it being tracked, is it actually being synthetically replicated or is it physically held, what is the track record in terms of the tracking error of that fund, those sort of things. So it's a very different type of analysis that is required for international ETFs.
And maybe, sorry.
I just had a quick question, just on the homework side, what are the legal and regulatory issues that investors need to keep in mind when looking at these types of international ETFs?
Well, I think you can have a lot of comfort in the fact that they are exchange traded. I mean, that's your international side. That's really what you want. They're exchange traded, and as I said, most of the big funds have a lot of liquidity. So you have comfort in the fact that should you need to exit a position, and you know some traders trade these intraday, and that's one of the fantastic benefits of trading international ETFs is a lot of the providers will actually give you gearing on the ETFs, whereas you know that's not possible through a lot of the more traditional funds, etc. So. Yeah, and you know, if you look at costs as well, you know, we're just talking about some of the risks. If you go into one of the traditional funds with your NAV, you know, all the investors on that day will get that, you know, will get that price. And often if you add additional funds over a period of time, a lot of the providers will allow additional funds to be placed in at no additional charge. You know, someone who's investing in an ETF over a period of time is paying brokerage because it trades like a share. They're paying brokerage every time they buy. So if you're doing that dollar cost sort of averaging over a period of time, you need to be cognizant of the costs associated with that, which aren't usually associated with the more traditional fund approach.
I don't want to obviously zero in on Deutsche Bank, but it's an interesting. I think it's an interesting question. Is that you've got a range of their local products that are here. The costs are pretty transparent if you were to buy them through one of the ETF platforms. What's the difference between if I were to go and buy and what's the difference in makeup of the product if I buy that X-Tracker here versus buying the product directly through through an international platform like SAXO?
Have you got comments? Because I'm not familiar with the international sort of buying them internationally. I'm only familiar with them sort of buying them locally in terms of the DB.
So what do you mean the difference in executing the actual trade?
Yeah, I mean, I'd be interested in just so the makeup of the product, so what you see in, and I picked X-Tracker just because I know there's a local and international, but I mean, maybe some thoughts on what are the costs involved with direct, what are the brokerage costs directly?
Yeah, I mean, international trades I think are a lot cheaper generally than the South African market. We tend to have a higher cost base here in terms of brokerage. But as you know, the US exchanges all trade on a cents per share basis, so we're not even talking about basis points. And I mean, most of the US markets, if you're trading through most international brokers, you're probably looking at 3 or 4 cents per share. So that's really kind of what you're looking at. So your lower priced ETFs, you'll probably be paying a little bit more, because you tend to hit the minimums on most of your trades. Most brokers have a $15, $20, $30 minimum on some of those trades, but generally, because they trade exactly like shares, 3 cents a share. And I mean, ARCA is the biggest exchange for ETFs. That's where the majority of the big funds are actually listed.
I think what I can also just mention in terms of that is the 5 Deutsche or DB X-Trackers ETFs that are listed in South Africa are all registered as CISs, unit trusts with the FSBs, which means they are foreign CISs, so they have to be 100% physically backed. And that's where a big part of the cost base comes in, because it means that these have got to have global custodians, etc., especially the MSCI World one, where they're trading across many different markets and so on. So the cost base of that would necessarily be higher than maybe in some of the international markets, where the UCITS regulations, which is the European regulations, do allow a proportion of synthetic replication of these. So our regulations are a lot better. We saw this past week with a global competitiveness report. Our regulation is the best in the world, but it comes at a price. We do actually pay for that better regulation. So to answer your question, Jessica, in terms of what do we need to take in mind, I think in South Africa, ETFs on the JSE, probably the best regulated investment instrument around. It's regulated by both the FSB and the JSE, but it does come at a cost, so be aware of that.
But is that cost going to come down significantly? Because I mean, like, if based on what Mike's, if you're looking at that cost, and I understand there's a couple of, it's not an easy to answer question straight away, but it almost seemed more compelling to set some money aside by the ETF when you feel comfortable, rather than just doing the sort of the monthly debit order approach to it, because ultimately those costs are high relative to the local tracking type product.
I think the difference comes in whether you are doing it through a stockbroking platform or through an investment platform, because on the investment platform you also find that the investors that all trade on the same day are pooled. So you do get some benefits, and especially those that do run the debit order offerings, where you are investing on a debit order date, you're actually pooled with a whole lot of other investors, so your debit order cost is actually relatively low compared to doing it through a stockbroker, where your minimum charges could be quite onerous, often in the region of anything from 80 to 150 Rand per trade. And I think one of the big things also to bear in mind is it's not just your initial ETF investment that you need to consider, but also your subsequent investments, especially if you want to do reinvestment of dividends. For relatively small amounts of money, if you want to be reinvesting those dividends, your brokerage is probably going to eat up most of those, whereas your ETF investment platforms actually will do that for you at a very reasonable rate, and you really can go into the sort of the compounding of your investment, something which is not really feasible through a stockbroking platform.